Hey everybody, this is Robert Palmer, Director of Financial Planning at Avidian Wealth Solutions. I'm here with part-time ranch hand and our Chief Investment Officer, Jake Borbidge, and we are going to talk about the 3 things you need to know when it comes to owning a second home.
Hey Robert, thanks for the intro. We're talking about something that I'm extremely passionate about, and hopefully some of our listeners are as well.
That's why I'm excited that you're here today to talk about this, because I know you have some personal experience with this, right?
That's true. I'm a multi-time ranch owner at this point in my life. It's something I've been doing for probably about 10 years now. It's a passion of mine, both on the personal side, lifestyle side of things. It's time that I could to spend and share with my family, but from an economic perspective, it can have some value there as well.
And I think that's where a lot of our clients have questions. You know, what is the investment potential and what are kind of the obligations and risks associated with owning a second home? Because the second home could be a lot of different things. You know, it could be a beach home, a lake home, or a ranch, for example. And I know that's very common here in Texas. So why don't we talk a little bit about the 3 things I referenced earlier, specifically as it connects to location, time, and the economic factors that we want to kind of consider here.
Okay. Yeah, I think, you know, for me, like, I'm an outdoors person, and so you're kind of hitting on the high points. Like, if I'm spending time outside, I want to either be skiing, I want to be on the ranch, or I want to be at the beach, right? And, you know, we have some of those options in Texas. We don't have all of them, so sometimes it means going out of state. If you're looking at a second home, or if you're looking at an investment property, the most important thing is to figure out the location. And it's not just, you know, where the best investment return is going to be. There's a lot of factors that go into determining the location. One is, you know, what's your passion? What do you enjoy doing the most? If you have to pick one place, which one is it going to be? And so when I look at it, I tend to look at, you know, beach and ski as something where it'd be awesome to own a home in either of those locations. I love going there. I love spending that time. But those are rentable locations. And so for me, when I looked at it, I chose the ranch. One, because it's really hard to rent a ranch, especially just for like a weekend. And 2, as a Houstonian, as a Texan, proximity matters. And I can get to my ranch in a couple hours. I can go out there for a long weekend, or I can go out there for multiple weeks at a time. You know, ski house, beach house. You can go to Galveston, you can get there pretty quick, but if you're thinking about Florida, you're thinking about one of those kind of, you know, more clear water type beaches, it takes a little bit of time to get there. So that's where, you know, we ultimately, my family's always settled on ranches, and we've done a couple of them in the past, you know, few years.
I think proximity is one of those things that people tend to overlook. I got a property up in the Northeast, and when I moved down here to Texas, having that property in the Northeast
not
is
a
just,
weekend place anymore.
No,
right?
it's just become a logistical nightmare, and all I want to do is get rid of it.
Yeah.
So, you know, what would be the ideal sort of distance for an individual that's looking to sort of manage a second home or just have a second home? You know, what are some of the key considerations that you want to think about?
So I'll address this mainly from the perspective of a parent first. And so, you know, when I had little kids, before they were in school, logistics of getting out of town were a lot more straightforward. I didn't have to worry about their schedules. It was primarily just my schedule. And so if I had a place that, you know, I could only go to for a week at a time, a little further away, not a big deal. And, you know, fortunately, I've had some flexibility in my work-life balance where I can go someplace and I can get some work done. As my kids have gotten older, their schedules have gotten more busy, and they often conflict with my schedules. And so that weekend retreat has become a lot more valuable, you know, in just kind of the work life, the school life balance that we have as a family with high schoolers. Now, that may change over time. As I think about, you know, my kids going off to college, it's probably going to be me and my wife, and we'll have that flexibility. We'll have a little bit less volatility in our schedules, and so that might change the calculus a little bit. But raising kids up through school, a weekend retreat, there's a ton of value there.
You see, my focus is primarily that things go wrong on the property. And so that's what stresses me out. You know, there's an electrical issue, there's a plumbing issue, and I need to let somebody in, but I'm 1,000 miles away from the property, and I need someone I can trust to be on that property to kind of fix everything up. And that's just probably the most frustrating thing for me, especially when you're dealing with tenants, if you're renting it out, you know, if it's not just purely for personal use.
Yeah, trust is big. And I mean, you know, from my perspective, I've been investing in ranch land in the same county for about a decade now. So I have trusted partners where if something needs to be done, I know who I can go to where they can come out to the property and get the job done, do it well, and I don't have to really worry too much about what else is going to go on while they're on the property. And you can get to that point any location in the world, right? But it takes time, it takes relationships, and there's probably going to be some challenges along the way, right? Because not everybody that you interact with is going to be trustworthy. Sometimes it takes a little time to kind of figure that out and build those relationships. But I would say that owning a second home, there are things that are going to go wrong, right? Just like your first home, pipes break, things flood,
That's right.
roofs get leaks in them. The same thing's going to be true of a second home, right? And that's going to be true whether it's at the beach. You got your hurricane risk out there. If you go up north, you're going to have freeze risk. You're going to have snow risk in ski properties. A ranch is no different. If you have a ranch with animals on it, right, you've got that to factor into it. Obviously, fires have been something that have been a concern of late. Forest fires, obviously, anywhere in Texas where we experience drought, that's something that you got to keep in mind and just make sure you're protected from that perspective as well.
Yeah, so basically distance and geographical features you want to consider, and I think personal preference is also really important. What are you comfortable with?
Yeah.
And that kind of brings it to the second point, which is about timing, not just in terms of buying and selling, but in terms of how long you intend to hold the property. So you personally, when it comes to the ranch that you tend to, did you buy that as a long-term investment or sort of a short-term investment?
So I'd say my perspective and my interaction with ranches has been, I'll call it intermediate term. Think about a 5-year plan with a potential, shorter term exit. But I've tended to want to be more of a ranch developer in my interaction. So I'm typically looking for a place that, has potential, but isn't a turnkey type of property. When I go to liquidate that ranch, I tend to want it to be a turnkey property. If you're looking for more kind of a turnkey property, you probably want to think, more 5 to 10 years minimum in terms of your holding period. But there's definitely variability there. But really, as with any real estate investment or anything that's not daily liquid, you do want to have a long-term perspective. You want to make sure at least, real estate, typically a good rule of thumb is if you're not looking to hold it for 5 years at a minimum, you might be better off renting. That's a very good starting rule of thumb. If you're more of a developer, looking for a place that you can kind of, improve on, enjoy it for a short period of time, and then move on to another place. Maybe that's more of a, 2 to 3 year window, but still be able to hold it for 5 years minimum.
Yeah, I think the type of capital improvements that you would normally do really varied based on the property that you're going to be investing in. So, for example, when I think of like beach houses or ski houses, sometimes there's some capital improvements you got to do to the kitchen or maybe the heating system, whatever it may be. But there seems to be a lot more variability in terms of ranches just because it's typically a much bigger piece of land. There's a lot more in terms that you could develop because there's just more to work with. What do you see in terms of differences between the two?
Yeah, I mean, that's a great point. So the more the bigger footprint you have, and that could be footprint in terms of square footage of the home, or it could be footprint in terms of the acreage that you own, the more variability that you're going to introduce, right? You buy a beach house, you can't really do too much to the beach. Buy a ski house, you're typically next to somebody else's mountain, and so you may want to, kind of lobby for improvements, but you don't have a whole lot of control over that. However, in a ranch situation, you have fences, and everything inside that fence is kind of under your control. So you really do have to have kind of a different eye for potential. And part of that is like the home. Typically, there's a home on a ranch, right? You want to make sure that that's a place that feels like it's your home. You want to put your fingerprints on it, and that's going to be the case with any property that you invest in. But when it gets into land, there are a lot of variabilities that you have to factor into it. So how are you going to use the land is a big one. Is the land that you're buying aligned with what your passion is? And so the properties that I've tend to own, they tend to be more, kind of timber woods type properties. Great for hunting, great for fishing, great for hiking and mountain biking, exploring on ATVs, side-by-sides. Not so great if I wanted to raise cattle, right? If, hilly property tends to be a little bit more rocky. You're not going to grow a lot of, hay. You're not going to grow a lot of grasses there. And so if I were, if my passion was horses, if my passion was cattle, I'd want to look for some place that's a little bit more prairie land, a little bit more flat, and probably a little bit more of a gentler terrain. And so, that's just kind of picking the place out and then seeing the vision, seeing, something that is kind of an unpainted canvas and what your fingerprints are going to look like. That takes some trial and error. You may not get it right on the first time. You may bring somebody in to do some work. You may do some work yourself. You may clear some trails that ultimately aren't that much fun to explore. You may, clear some land and it doesn't turn out the way you want it to turn out. The good thing with land is that, if you do make a mistake, nature does tend to heal things. And so nature can heal your mistakes over time, and you can move on and try to do something different.
So I think we're sort of skirting around the edges of the third point I wanted to bring up, because we've started with passion, right? We're looking at location and timing, how long I want to hold the property, where do I really want to be going all the time to check up on things. I think the meat and potatoes that most people want to jump into is, what are the economic benefits? How is this going to benefit me? How is this going to benefit my family into the future? And how do I leverage this in terms of just diversification within a portfolio, if I'm looking at it from that perspective?
Yeah.
So immediately, what kind of jumps off the page for you as a ranch owner in terms of an economic benefit?
So that is definitely something that I spend a lot of time thinking about at the entry point as I own it, and then at the exit point. And I would definitely say, ranches, you're going to have more degrees of variability. And so when there's more degrees of variability, more options available to you, things can go correctly or they can go poorly, right? And you have that discretion, you have that at your disposal. You think about your traditional rental property, ski house, beach house. I mean, there's tax consequences. There's a economic analysis that needs to be done, but you're primarily just focusing on a smaller, range of expectations, for lack of a better term. With a ranch, there's the value of the home on the property, but there's also the value of the land. And, in terms of from an investments perspective, one of the things that I like about ranches is that a much larger portion of the overall asset is tied up into the land value. And one of the things that we tend to assume about real estate is that it always goes up, but in reality, the building on a property it's built of things that do depreciate over time. And any house that you buy, there's a portion of value that's land, there's a portion of value that's building. You're able to depreciate a building for good reason, right? Buildings do lose value over time. They have maintenance requirements. And so when a larger portion of your asset is tied up in the land side of things, land typically requires less maintenance and actually is expected to go up over time. A building per unit of value will require more maintenance to keep its value over time. So that's one difference where, like, if your ranch, land, if that's 90% of the value, 90% of the value is just going to go up because of scarcity. That's one thing that I've tend to find is more economically attractive. Now, what ranches don't bring to the table is they typically don't bring a lot of rental income. You can generate some small levels of income from the agricultural side of things, and some people get pretty involved in that, especially with cattle. That income can become fairly substantial depending on your ranch size, but it typically tends to be a smaller pool of the overall economic value of the asset, where the income produced from a ski house or a beach house could be substantially more in terms of the overall return.
So however, is it fair to say that it's basically on the resale side that you're going to really make up for that differential from lack of cash flow from a rental perspective?
Yeah, that's primarily like your liquidation value on the ranch, but there's also in the interim there's substantial tax benefits that you can harvest through owning ranch, and so that's where, again, more degrees of freedom. If you own a ranch, if you own rural land, there's an agricultural component to it as well, and that can significantly reduce your tax liability in terms of being the owner, but there's also additional tax benefits you can harvest through different agricultural programs, different expenditures that you have on the ranch that tie into the agricultural benefit, the agricultural development of that property. You don't have those with your more traditional rental and ownership.
Well, before we jump into the tax benefits, I want to talk a little bit about appreciation, because most people, when they think about real estate, they try to think about, how can I capitalize on my dollar? How can I get that appreciation moving forward?
Yeah.
My personal experience with rental properties up in the Northeast, I would have to put a lot of capital improvement into a building and not really see a whole lot of appreciation, particularly because it tends to be in a metropolitan area, right? So you don't really get a whole lot of bang for the buck when you're in that sort of capital investment situation. Now, when you're dealing with raw land, like with a ranch, there seems to be a lot of room for capital improvement just to improve the land in general, whether it's erecting structures or perhaps irrigating or something along those lines. Do you think you get a better rate of appreciation for every dollar you spend in improving the land?
So I don't necessarily know if I'd call it a better rate of appreciation, but it is differentiated. And there are, we talk a lot about diversification, right? The drivers of what are going to make your ranch land attractive are going to be different drivers than what's going to make your, metropolitan rental property attractive, right? Metro rentals, they're going to be driven partially by, the growth of that urban market. And
Yep.
so if that urban market is experiencing substantial growth and you have proximity to that market, that could be your main driver. Whereas, ranch land, it could be, you may buy a property that just hasn't been taken care of for a while, and, a couple of months on, with a hand on a tractor can make a big difference just in terms of cleaning it up, the aesthetics of that property. And those investments tend to be fairly lower on the dollar components perspective. Bigger investments like, you see a property and there's a lot of potential for, building a large lake or, water features. Those do tend to, at least in my perspective, add significant economic value, but they're bigger capital projects, of course, right? And they do take longer and there's more risk, right? A lot of times, if you build a water feature, obviously the water has to come. And depending on the size of that water feature, you may not be able to supply that water on your own, right? As a rancher, as a farmer, you tend to be reliant on nature to deliver some of the economic value, and so that's something that you have to depend on as well.
That makes sense. Yeah, there would be a pretty substantial differential between what exactly you're purchasing, because it seems like ranches, you're purchasing the land and you're making capital improvements and you're really just trying to make the land more valuable over time. Whereas the metropolitan area, you're buying a cash flow, right? You're buying an income stream.
Yep.
And that can be subject to a lot of variability depending on the area. I could speak from experience again when I tell you tenants are extremely frustrating to deal with in certain circumstances, particularly if you don't have consistent tenants or perhaps long-term commercial tenants. So it's almost kind of nicer to have a situation where you kind of can have a one-to-one with the money and effort you put into the land and some appreciated value out of it, and not really contingent on someone getting their paycheck every week and making sure they're paying the rent.
Yeah, and I think another thing to consider, because we're talking about different types of luxury vacation rental type properties. Owning a ranch, the cash outflow, as long as you're not doing a major overhaul, a major capital investment project, the cash outflow can be more modest. And again, going back to like the investment merits, right? If you compare it to a beach house, right? The cash flow component, a lot of the way that beach houses are priced is in any asset, right? Any asset's going to be priced based on its appreciation value or how much the asset is going to go up in price, and then what cash flow it's going to generate. If you buy a beach house as a vacation property, but then you decide, well, I really like this place, I don't want anybody else using it while I'm not there, and you choose not to rent it out, then you're foregoing all those cash flows. However, when you purchased the property, you paid for the economic value of those cash flows, and so you're giving up a lot of cash flow. Whereas on a ranch, the economic value, there's no cash flow priced into that purchase unless you're buying something that's a functioning farm or a functioning cattle ranch. That's priced in, you keep that going.
Sort of a lower barrier of entry.
Lower barrier of entry, and also, if you want to own the ranch and not rent it out, right, you're not really giving up a ton of economic value because you didn't pay for that value on the way in. And so a lot of times what I'll see is, somebody will look at an investment property like a vacation home. They'll talk to the realtor. The realtor will give you kind of an investment projection on that property. Those projections will typically include a large portion of the days that you're not there being rented out, right? So that cash flow component.
That's right.
And those aren't necessarily bad predictions, but if you choose to forego those cash flows, then you got to expect your returns got to come down substantially. We haven't felt that a lot over the last 5 or 10 years. COVID has driven just a tremendous amount of interest for really all kinds of luxury recreational properties. And so the returns on all of these properties have been pretty substantial over the last handful of years. But that's not the case historically. That's not the case that you should expect going in, right? That's a fortunate situation to be in. But going forward, we shouldn't expect that to be a repeat.
So, I mean, it kind of sounds like a big differentiation is understanding whether you're buying the property as an investment or just for personal enjoyment. And I think that sort of a marriage between the two is going to be really important, because you might start off buying a property just for your family, take them out of the city or take them into a different area, a different experience, but ultimately want to get a return on capital at some point into the future. And I think that's where tax benefits come into play, because the tax benefits on land or even rental properties, they vary quite substantially, and they also have long-term and short-term implications for what you're able to do moving forward. So if you're looking at something like, let's say, a beach house versus a ranch, what are some differentiations in tax benefits that one could expect?
So that is definitely a great question. I think, again, more variability, the more land and flexibility that you have. But that's typically where we tell our clients to talk to our financial planning department. So Robert, I'll cue you up. I mean, this is this is really your wheelhouse, right? Are we buying these things into trust? Are we forming a company to buy these things? Are we just owning them outright as individuals? What's the right structure there?
Yeah, I definitely ownership should start off with a risk management assessment. How should we own this property? I would say that if you're intending to rent out any property, establishing at least an umbrella policy that covers your liability,
That's a great point, yeah.
or a corporate entity like an LLC or something that removes you. It gives you a degree of separation so that your personal assets aren't going to be on the line if someone trips and falls or some kind of accident occurs on the property. And then, of course, there's destruction of the property, right? In the event of a natural disaster, you just want to make sure that you're calculating these expenses and these risks moving forward.
Yeah.
Typically, if you're renting, you need some kind of corporate entity in order to carry forward losses. So if you have a rental, for example, and you wind up putting a lot of capital improvements and there's a loss on the property, you're not going to be able to carry that forward unless it's structured as a business. So if you want to write it off against other income, there needs to be an active use, and it needs to be in a corporate entity in order to make everything squared away with the IRS. There's some flexibility there, but that tends to be the hard and fast rule of it. On the back end, what I would say is that if you're thinking long-term, where do I want this property to go? Do I want it to go to my kids or do I want to sell it? That changes how you want to own it as well. So if you see that there's going to be rapid appreciation within the estate, or rapid appreciation in the land, I should say, then it makes sense to put it into trust, right? Your kids may not be perfectly apt in managing the trust or managing the land, I should say. And so having a third party or a custodian that's familiar with how to manage the property will just make things easier and avoid family disputes. But this is where conversations with your family members really come into play. You want to make sure you understand what responsibilities your kids want and ultimately what you want to do with the land and if it's going to trigger a taxable event. So I would also add that because a lot of people will look at ranches and raw land as an opportunity to basically inject capital improvements and really just elevate the land from where you're buying it, there's also an opportunity for depreciation, right? So you might want to look at that as, okay, I can put money into something and then also start pulling some money back out in the form of depreciation to write off against income. So you don't necessarily need a loss, right? And those are typically the tax benefits we look at, losses and depreciations, and we want to write it off against other income streams. And we want to make sure we're managing the risk, either leveraging a trust or a corporate entity. That tends to be the general categorization that I look at.
So just to clarify, are you going to own this ranch through a corporate entity and a trust, or are those mutually exclusive?
They're mutually exclusive. They can work in tandem with each other, but it really depends on your intent. I would say that if I'm looking to eventually give the land to my kids, I'd probably want them to own it in trust. And the way that I would set that up is I would basically create a holding company for the land I own, sort of like a family limited partnership. And then I would gift out limited partnership interest into trust for the kids. If it's in trust and I'm the trustee, I still control everything. And the kids will eventually inherit it, but there won't be any estate taxes at the end of the day. However, if I don't want the kids to inherit it, I'll just keep it in a corporate entity. And that way, if I run it like a business, I might be able to exchange it in a tax-deferred way and also carry forward losses or depreciation and capitalize on those tax benefits for myself.
That's a great point. So I think we kind of want to touch on one last thing before we finish out here today, and that's really just how does this component or this piece of your overall portfolio factor into everything else that you own? And I think the first thing to mention is that when you talk with your financial advisor, when you're doing your investment planning, don't keep this as a side investment. Incorporate it, right? Help us to understand the correlation of this potential asset class, how it might interact with other things that you own, both from a risk perspective and from a return perspective, and also help us to understand whether anything that you own can create potential stresses that might put this property at risk. So having a holistic conversation with your financial planning team, with your financial advisor, can also help to protect this asset and make sure that it's secure for your family's future in the long term.
Yeah, I think you hit the nail on the head. If you're truly going through a comprehensive investment management and financial planning process, you really need to be bringing in all the assets that are under your purview and making sure that you're managing those risks and understanding the levels of diversification and concentration that you have for both your sake and your family's sake.
Robert, this has been a lot of fun. I could talk about this for hours, maybe even days. Maybe we'll have the discussion on the ranch next time, a little bit more peaceful environment. Please, if you have questions, reach out to your Avidian Wealth advisor. Visit us at www.avidianwealth.com. Also, don't forget to hit the like or subscribe button.